Microsoft stock, ticker symbol MSFT. This stock is up 23% on the year-to-date chart, while the overall market, in this case the S&P 500, is up roughly 7% year-to-date, so that's a big difference. Yesterday, Microsoft presented quarter results where they beat on EPS by a decent margin, and also beat on revenue. To me, this was a bit surprising, but more on that in a minute. For the upcoming results, almost all analysts expect a miss, which is kinda interesting. From a dividend point of view, things look pretty decent with dividend yield at 0.99%, which is not that high of course. However, it's a tech company and many people still classify Microsoft as a growth stock, so 1% dividend yield is not that bad. On top of that, they have 18 years of dividend increases. But does this mean that Microsoft stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Microsoft does, the most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, comparison versus some major competitors, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Microsoft do? Microsoft is the largest vendor of computer software in the world. It's also a leading provider of cloud computing services, video games, computer and gaming hardware, search and other online services. Microsoft reported a revenue of 52.9 billion and 7% increase year over year, or 10% constant currency. Which is insane. Microsoft is one of the biggest companies in the world and is still able to grow their revenue at high numbers. The three main segments are productivity and business processes, intelligent cloud, and last but not least, personal computing. The first segment, productivity and business processes, reported an 11% revenue growth year over year, which is very nice. The biggest segment, Intelligent Cloud, reported a 16% revenue growth year over year, which is also very nice. And the third segment, Personal Computing, reported a 9% decrease in revenue year over year, which is a bit disappointing of course. Gross margin increased 9%, meaning margin percentage is increasing a tiny bit. Operating income increased 10% and also increased a tiny bit, which is very nice. Diluted earnings per share increased 10% year over year, which is also very nice of course. And to be honest, these results are pretty impressive. In this table we see that Microsoft Cloud revenue has increased quite a bit over the past couple of years. And gross margin has increased as well to 72%, which is an insane number and a real cash cow for Microsoft. When we check the three main segments again, we see that Office, commercial products and cloud service revenue increased 13%, while consumer products increased only 1%, which is very interesting. LinkedIn increased 8% in revenue, and dynamic products and cloud services increased 17%. In the second main segment, Intelligent Cloud, we see that server products and cloud services increased 17% in revenue. And in the last main segment, Personal Computing, we see a lot of decreases. Windows OEM revenue decreased 28% and devices revenue decreased 30%, which really hurts to see. Windows commercial products and cloud services increased 14%, which kinda saves the day a little bit, and Xbox increased 3%. Search and advertising increased 10%. In this sheet we see that Office commercial products is growing in high amounts and is gaining some momentum. However, the consumer products and cloud services are falling behind, as we saw a minute ago. Microsoft 365 subscribers is still growing in high amounts, which is very nice. And LinkedIn is also falling behind in revenue growth year over year compared to previous years. The second main segment, Intelligent Cloud, is also an interesting one. Server products and cloud services had an insane growth numbers in the past couple of years. Right now it's still growing in high amounts, but growth is starting to slow down a bit. And the last segment, Personal Computing, has two sub-segments that are falling behind big time. Windows OEM and devices revenue growth year over year, So definitely keep an eye on those two segments. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Microsoft is a 2 trillion market cap company, which makes them one of the largest companies in the world. PE ratio is at 30, which could indicate that they are at a premium price right now. However, keep in mind that Microsoft has some great growth numbers for a company this size. Later in this video I will show you my 3 price targets for Microsoft, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 204 billion, and in this graph we see that revenue went up quite nice and steady since 2016. Over a longer period of time margins are going up, but it's not really steady and consistent. Ever since 2022 margins have decreased a bit, so that's something to keep your eye on. EPS is pretty much the same story as the margin. It's up in the long run, but it's not really steady and consistent. Most recently it took a hit. Price to sales ratio is at 10 right now. Over a longer period of time it's going up, and the current number does not look good to me. But for a tech company it's pretty common to have a higher number here. And price to book ratio is pretty much the same story. Nevertheless, keep an eye on both numbers. Analysts expect EPS to increase only a tiny bit in 2023. But in 2024 until 2026 they expect 15 to 30% increase per year. And it's pretty much the same story with the revenue expectations. In 2023 we see lower numbers, but from 2024 to 2026 we see 11 to 20% increase per year. Return on assets is sitting at 13.7%, which is above my 10% minimum. Return on equity also looks really good. And the most important number, return on invested capital, is sitting at 22%, which is a really good number. But the thing that I don't like here is the fact that it's lower than the 5-year average. Nevertheless, 22% is still a really good number. Current ratio is at 1.93, which looks pretty decent to me. For this type of company, I prefer a number below 2. The thing that I like here is the fact that it's decreasing over a longer period of time. Total debt is sitting at 78 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at almost 99 billion, so they can pay down all their debt and still have a lot of money left. Nevertheless, it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back share, pay dividends and all other things. And in here we see that free cash flow is going up quite nice and steady over a longer period of time. The amount of growth is really impressive. And then another thing that I love about this company are the shares outstanding. It's going down in the long run. It means when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 0.99%, which is a decent number for a tech company. Annual payout is at $2.72 and payout ratio is at only 28%. I prefer 50% or lower, so right now they have roughly 72% left in cash to buy back shares, pay down debt, acquisitions, research and all other things. The 5-year growth rate is at almost 10%, which is a great number. On top of that, they grew the dividends for 18 years in a row, which is also pretty impressive. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that over a longer period of time, payout ratio is decreasing, which is a good thing. In this graph we see the expected dividend in 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. In 2024 it's expected to increase to $2.85 and giving you a 1% dividend yield. And in 2025 it's expected to increase to $3.25 a share, giving you a 1.18% dividend yield. Overall, these dividends looks pretty good to me. But how about the historical returns? I decided to compare Microsoft stock with the overall market, in this case the S&P 500. Next to that, I added some big companies like Oracle, Google, aka Alphabet, and Apple. On the 5-year chart, we see that Microsoft had a 216% return including dividends, beating the S&P 500 big time, which returned 68%. Apple had the highest return with almost 320%, and Google had the lowest return but still has beaten the S&P 500. On the 1-year chart it looks pretty different. Microsoft returned nearly flat numbers, while the S&P 500 returned minus 3.5%. Oracle had the highest return with 24%, and Google had the lowest return with minus 15%. On the 6-month chart it's again Microsoft that beats the S&P 500 and most competitors with 10% return, while Oracle has again the highest return with almost 30%. On the 1-month chart it's again Oracle with the highest return. Microsoft had the lowest return, but to be honest, it isn't a big difference with the others. So bottom line, Microsoft has beaten the S&P 500 big time in the long run, and most recently it also looks pretty good for Microsoft. But how about some fundamentals compared to the other companies in this list? We see that these 4 companies are quite different in market cap, enterprise value and employees. Microsoft has the highest PE ratio together with Apple, which is not a good thing per se. Price to free cash flow is also the highest at both Microsoft and Apple. Revenue growth year over year is the highest at Microsoft and Oracle. The 5-year growth rate is the highest at Google, but Microsoft is sitting in the second spot here. The net income compound annual growth rate is also the highest at Google. Last but not least is the free cash flow compound annual growth rate. Google is again the winner here. Oracle has the highest gross profit margin and Microsoft is again in the second spot. Net income margin is the highest at Microsoft and so is the free cash flow margin. Return on total capital is the highest at Apple, but Microsoft is again in the second spot here. All companies have more than enough cash to pay down a big chunk of their total debt, which is very nice, except for Oracle. And the last thing that I want to check are the dividends. Oracle has the highest dividend yield and Apple has the lowest payout ratio, but Microsoft is doing a decent job here. The 5-year compound annual growth rate is the highest at Oracle, and the most consecutive years of dividend increases is the highest at Microsoft. Overall, I think Microsoft did a great job in most parts versus the competitors. They were in the second or in the first spot most of the time. But is Microsoft stock a buy at current numbers? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 9%, 10% and 11%, since I think they will increase their revenue at the same numbers versus the historical averages. Next to that is also based on the analysis expectations and the current outlook. Profit margin I'm filling in 32, 34 and 36%. For the free cash flow margin I'm filling in 30, 32 and 34. For the PE ratio and the price to free cash flow I'm filling in 20, 22 and 24. It's a big company with great fundamentals, and in some areas even a moat. Next to that they are able to grow at high numbers, which is kinda impressive given their size. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now Microsoft stock is at $297. I hit analyze, and we only see one green number. We have a low price target of $192 to $204, which is a big drop from the current stock price. We have a mid price target of $235 to $249, and we have a high price target of $286 to $303. To me, the high price target is the most justified here. And I know this is a scenario with high expectations, but I really feel confident about the future for Microsoft. The current business model allows Microsoft to grow at high numbers, and with the booming AI, I think they will do a great job in the future. However, based on this high price target, they are only undervalued by $6, giving you not much room to grow, so that's something to keep in mind. My final conclusion on this stock is that I really love the company. It's the biggest position in my portfolio and with reason. They are growing at insane numbers every year for a company this big, and they have great fundamentals. Dividends are pretty decent and they have so much cash to improve the business. However, you pay a premium price for this stock, which not everybody loves to see. PE ratio and price to free cash flow are a bit on the high side, giving you not much room to grow in stock price according to my high price targets. Nevertheless, I'm still very optimistic about the future, and I think they will do great both short term and long term. For now, I'm slowly adding more shares whenever the stock price drops. Right now, it's a bit on the high side, so I would love lower prices. The question is if we are going to see lower numbers in the coming periods after these great earnings. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.